Hi and welcome. My name is Brendan Kelly and I'm joined today by Simon Buckingham. Welcome, Simon.
Thanks, Brendan. Hi, everyone.
It is a pleasure to have you join us this evening. Tonight's conversation has the capacity to really support people who are stuck, who are looking to build a portfolio, who are looking to make their way towards financial freedom and a stability for themselves that will last them for the rest of their lives. But they just can't seem to get past a certain point. There's something that's just getting in the way. If we think differently, there's an opportunity to move past that stuckness. And that's what tonight's conversation is all about. Introducing ideas that are variant on what you may have heard before that opens the door to you accessing more money or better financial outcome, a faster conclusion to your journey, and a more joyful existence. Awesome. All right. Before we do, let's do some introductions. Say hi. Allow me a moment to introduce ourselves. Who are we? Well, we're property investors, have been so for decades. The grey hair should probably give that away. And we've had success on a variety of different strategic approaches. We have done buy and hold negatively geared, buy and hold positively geared. We have done active investing, renos, subdivisions, developments. We have done overseas investing, local investing. We've done money partner agreements, joint venture agreements, commercial investing, industrial developments. We've played the game. But what that's allowed us to do is learn a lot about the property investing industry, the property environment. And based on what we've been able to pick up over the years, we've seen that there's value in sharing that knowledge so that other people can do it more easily, more safely, more securely for themselves. So to that end, we wrote the book, The Real Deal. We write regularly for articles and blogs. We are educators, public speakers. We share information when and where we can to support people to do it better for themselves. Recently ran a TV show on CTV Plus, aired predominantly in Adelaide and Melbourne. Bit of fun. We recently launched an app, and I encourage you to actually access that app. Why? There is a wealth of knowledge in there, an abundance of information. But beyond that, there's a group of peers that you can talk to. Jump onto the real estate success community. You can zap your phone on that QR code on your screen right now, or just simply go onto the Google Play or Apple Store apps and look for real estate success community, and you'll be able to find it. Jump on and start to access the material there that's designed to help you do your investing better, and start to meet and greet some of the people who are in the community already. It's a really supportive community. Culture is very, very favorable and positive. One of the things we also do is run a company called Property Predictions. It's a property market research analytics organization. It's pretty successful in being able to forecast median price movement, not just nationally or in city based, but at a suburb level. And that gives us an insight, and with shared wisdom, an insight into where the market is going. And it gives you the ability to make better and more informed buying decisions, which can be really powerful. The greatest capacity, though, that we have to support someone is through the results mentoring program. We've been running this program now for 20 years and had great success for members. For example, Adam, he came to us about 10 years ago and said, I've done a reno, had a bit of fun, could have done better. Have you got a system that would allow me to do renos more efficiently and then grow into more? We said, actually, funnily enough, yes, we do. And we educated him through that system. And he was able within 5.5 years to recognize he was actually earning more money from his property investing activity than he was from being employed. And it didn't make sense to be employed anymore. So he quit. Currently, 17 projects being undertaken simultaneously worth more than $50 million in value. The guy is just doing extraordinarily well. And the beauty here, he's not alone in that as an approach or as a success. Catherine, as an example, came to us, single mum, couple of kids, part-time job, doing it tight, and said, there's got to be a different way to doing life than how I'm doing it. Can you throw me a little bit of an insight into what might be doing differently? And we supported her through techniques, systems, approaches to doing property investing such that within 5 years, she no longer needed to be employed. She is just loving life with a beautiful home on the beach. Profits to date in excess of $5 million with another 2.5 underway. Magnificent journey for her. And to turn life around, extraordinary. But again, not alone. James, he'd never actually done anything in property before. And he said, I can do this by trial and error. Oh, Simon, what is the problem with trial and error?
Error.
Yeah. You make a mistake and it hurts. You lose money, you lose confidence, you lose time. There's pain. And he was kind of smart enough to identify that actually that's probably not the way to go. And there are safer ways to do this. Do you guys teach, support, train, help people with no knowledge to be able to do this better? And we said, actually, yes, we do. And we worked with him. It took him 5 years and 4 projects of increasing complexity and value over that time frame to be able to go, I've seen now how much money I can make out of property. I've seen that I can earn more from property than I am doing from my job right now. You know what? I quit. I'm out. Profits to date, 3.6 million. Brilliant.
13.6 million.
So, apologies. 13.6 million.
That's what's an extra 10
million.
Well,
what's an extra 10 million? That's right. Between friends. And entertainingly enough, when he left, he's on the way out the door, his boss tapped him on the shoulder and says, hey, if I give you my money, can you invest for me? Which I thought was just brilliant. If this is the sort of thing that appeals to you, if that's the sort of journey you think you might want to go down, or at least talk through and see what might be possible for you, we've got the opportunity for you now. Reach out, book a time that works for you, and have a conversation about what you're up to. And we'll talk about where you're at with your portfolio. We'll talk about where you're at with your dreams and visions and what it is you want to do for yourself. We'll talk about where you're stuck and what you might need to do next. And you'll be doing so with a mentor, an expert property investing mentor. If you've never spoken to a property mentor before, it's actually quite an inspiring conversation. No cost, no obligation. The contribution to where you're at could be life-changing. So I put it out there. If you want to, great. No obligation, no consequences. So tap in. Cool. All right. Today, though, the topic of conversation is centered on how to build a multi-property portfolio and the ability to control the outcome of that portfolio so that you can live the life of your dreams when you want to.
Yeah, so tonight is very much about thinking differently to how most people invest. Most people get stuck at just 1, 2, or 3 investment properties and really struggle to get beyond that. And we'll go through tonight some of the reasons why that is. But what we really want to do also is open your eyes up into a different way of approaching your property investing, ways you might not ever have thought of, that you might not even have heard of, that could really catapult your investing to the next level and enable you to build that multi-property portfolio that's going to deliver the lifestyle that you ultimately want. So a few things we're going to go through tonight. We'll have a look at why that traditional approach to investing, why relying on capital growth and leverage alone just doesn't work if you want to build a multi-property portfolio. And we'll explain why that is. And we'll dive into how you can do things in a more sustainable and scalable way, how you can really start to scale up your investing over the coming months and years. We will have a chat about something we call your path of least resistance, helping you figure out what is the ideal way forward for you or what your next property opportunity might look like. And then we'll talk about one of the fundamental barriers to building your portfolio, which is funding. Where does the money come from to actually build that portfolio? There are people who talk about using things like trust structures to replicate your borrowing. We're going to unpack how that works or doesn't work. We'll talk about some lesser-known finance strategies and some ways to tap into private funding as well. And then we'll round out this evening, hopefully, with a few examples of how thinking differently can give you a very, very different outcome when it comes to your property investing. We'll start with where most investors get stuck. The typical investor will go out and buy a property. They may be able to afford to buy another property. And then they start to run into some issues. The bank starts saying, well, you're at the end of your borrowing capacity. You can't borrow anymore. or they've used up the money that they had for their deposits. There's a whole lot of things that keep you shackled, really limited in what you might be able to do with your property investing, or what you might aspire to do with your property investing. Things like limited capital. Where does the money come from for deposits? I need to save it. Or I need to be able to borrow it out of a property, which means that property has to go up in value. It's very easy and very common. And we would have conversations, Brendan, I think all the time, with property investors who say, I'm at a borrowing limit, I'm maxed out. The bank says I can't borrow anymore. How can I possibly move forward?
Where do I go? What do I do? How can I keep going?
Exactly. It's often the case that people who've been in property investing for a while, they've held a property for a while, or whether it's their own home or investment properties, and they've built up some equity in that property. It's potentially gone up in value over a few years. They might find themselves in a situation of being equity rich. They've got a lot of equity in this property, but they can't actually get at it. But more to the point, they are really struggling just with the constant payments on the loans, the outgoings, the negative cash flows on the property. They're cash flow poor. And for many investors, it's a combination of all these things that keeps them shackled or limited to what they're actually able to do. Now, Brennan, the fundamental reason why all of these issues come up, essentially, in my mind, comes back down to how people are investing. The traditional investing approach that most people pursue, this idea that you'll buy a property, you'll hold that property, you'll never sell that property because you're looking for it to go up in value. So why would you ever sell it? Brennan, would you say that's fair, that's the typical investing approach most property investors take on?
Oh, it is the typical one, but interestingly enough, it's the one that most people literally fall into. I need to think about making sure that my life's okay. I've got to prepare. Super might not do it. There's a whole pile of things that go on in the brain around getting life sorted. And one of the things is, if I've got a couple of properties, or I've heard this property thing, or you've talked to people and I've got a property investment, and you've got these stories that come from your peers, the people you know. You go, actually, all right, no, that sounds like a reasonable idea. Is it hard to do? I think I can do it. And you go out and you go, I'm going to need a loan, talk to a bank or talk to a mortgage broker. Yep, you're going to lend money. Great. What can I afford? $500,000. Great. What do I do now? Go and buy something for $500,000. And how do I make money? Just don't ever sell is the message. Yeah, you just don't ever sell, because it takes time for the property to go up in value. It takes time for the markets go up and down. You don't want to be caught out in the fluctuations. You don't want to sell it at the worst time. You won't know if it's the worst time, so don't sell it. And just hold on to it forever, and then you'll be okay, because you pay it down over 30 years.
And if you do sell it, you'll have to pay tax. So don't ever sell it, because you don't want to have to pay tax on the gain.
Correct. And if you do buy it and you hold it and the rent doesn't cover it, the government will help you to buy it by giving you negative gearing compensation for it.
Tax deductions. Cool.
And in fact, accountants whose jobs are to provide the best tax refund they can for you in a year can wear badges of great honor saying, look how much I saved you in your and gave you as a refund, because I was able to make your life look like you're serving such a loss. Well done. And you go, oh, cool, I've got a tax refund now. But the fact remains, you're out of pocket every week.
That's right. The only way you save tax is by losing money.
Yeah. And as a consequence, you go, and all these things kind of trap you. You had the image before of the shackles around the wrists on. That's exactly what it is. You're buying a property that has a negatively geared component to it, such that you're out of pocket to service it. You're not ever going to sell it because you got to wait 30 years to see any profit in it anyway, or get the rent that you want as a passive income stream in retirement some long way down the track. So you've got to endure holding this thing until such time as it's not negatively geared. But then you borrow more money and it's negatively geared again. But you've got to endure all those negative geared components. And it ties you to your job. You can't afford to leave or quit. because you got to service the debt to hold on to it. And it becomes a plan A self-fulfilling bind, again, speaking to the shackles.
Yeah, exactly. So even if the property's going up in value, right? So you've bought something, let's say you bought well, you've timed it well, you've got a property that's going up in value, it goes up by tens of thousands, hundreds of thousands of dollars over a period of time, and you go, great, I've got equity in that property, I'm going to borrow it out. You borrow that money out assuming you can afford to, and that the bank will say, yes, you can afford that loan. You borrow that money out, so your equity's just diminished. It's just been transferred into debt again. You use that debt to go and buy another property. So you basically move that equity into another property and you go again. And you're stuck in the same cycle. We're waiting for that property to go up in value and the original one to go up in value so that I can eventually borrow again. And there are plenty of the more traditional property spruikers out there that talk about this idea that you're going to buy one property after another. They're going to go up in value. You're going to leverage the equity. You're going to take that equity, use it for the deposit on the next one and go again. The
10 properties in 10 years.
Correct. And the fundamental flaw in that approach is that every time you borrow out, your borrowing capacity diminishes further. So if you weren't at a borrowing limit on your first property and you're not at a borrowing limit on your second property, come 2, 3, 4 properties down the track, you start to find that you've got less and less borrowing available to you. You've got, therefore, a lesser and lesser expensive property that you can actually afford to buy, or you get to the point where you simply can't buy anything because you can't access the borrowing anymore. And that is the fundamental flaw. You run out of borrowing capacity before you've built your property portfolio to the level that you really want it to be.
And now, most people take on the idea of waiting. No, the properties will go up, the rent will go up, my income will improve, I'll get a pay increase, my income through experience for my job will improve, and then I'll be able to go again and keep going. And correct. See, it sounds like we're bashing buy and hold. It sounds like we're here to bash and make everybody wrong who's got a buy and hold property. That's not the case. This is designed to be a conversation that is open the mind to thinking differently, because the single path of repeating the process has limitations. And this is what we're attempting to highlight. The limitations that single path of thinking can get you stuck into. Exactly. And if you open your mind and think differently about it, then there are ways to break free from what you've set up for yourself, or from the limitation of that myopic approach. That's all.
Exactly. So what we want to do is take you from wherever you're at now and really take you up a level or 2 or 3 to the point where you can achieve the kinds of things with your property portfolio that 1% of property investors only ever achieve, because the vast majority don't know how to do anything differently. They're stuck in the same old traditional methods, and that gets them the same as everybody else. If you want something different, then it makes sense, doesn't it, that you have to do something differently. I mean, Brendan, when I woke up to that concept, in the short space of just 3.5 years, I went out and bought over 30 properties. Now, most people don't do that. Most property investors don't do that. They get stuck at 1, 2, or 3. So how could I go and do that many properties in such a short space of time? It was about thinking differently and understanding how to do things differently. And that's where we're going to try and train you up tonight, is talk about how to do this in a way that's more sustainable, more repeatable, more scalable, to help you build that multi-property portfolio that you want to have.
Okay. What is the big thing that is the shock news that might need to be said, that is something that typically most people don't want to discuss?
We're going to get a little bit heretical, I think, Brendan. And this goes against the supposed common wisdom that's out there that really isn't wisdom at all. This whole idea that you should never, ever sell, that you buy a property, you hold it, you just hang on to it, you ride the ups and downs, eventually she'll be right, mate, you'll be okay, and you never, ever sell. Well, the reality is that if you want to build a multi-property portfolio, and it's ironic that I want to have multiple properties, it's actually highly likely that I'm going to have to consider selling along the way. And that is a big shift in thinking for a lot of people. A lot of people are, dare I say, indoctrinated into the idea of,
again, myopic.
It's bad to sell a property. I mustn't sell because I have to pay tax. I mustn't sell because it's a long-term strategy. Well, yes, there are long-term property strategies, and some of those long-term strategies might serve you. But if that's the only way you think, then chances are you're not actually going to achieve the outcome that you want. You've got to think differently and start to broaden the horizons. If you want to build a multi-property portfolio faster, then this may actually require you to sell rather than hold some of those properties along the way, at least in the short term. And we want to unpack tonight why that is.
Your key component here that you're speaking to in the background is a component of time and timing. If you're a 20-something and you've got 40 years and you've just started a career that you're really happy with, by all means, and more power to you, you can do the traditional non-variant. You've got 20, 40 years to play the game, to accumulate the number of properties you want. Off you go. Wonderful. If you're in your 30s, you're less time, 40s, less time, 50s, less time, again, 60s, you've got to be going, I'm out of time. I can't do the compounding growth thing from holding properties. So I'm going to have to think differently. So it's a time conversation. So where are you at in your life? What time do you have left? And what is the outcome that you're after? Now, if you have a look at the finances in your life, the number of properties you've got already, how many years to go that you're working, what sort of existence you want post-work, when you might want post-work to be, could only be 5 years from now or 10 years from now. So, those sorts of big ticket questions, you look at that and if you correlate your experience with property now to date with the timing of what you've got left, there might be a revelation that says, actually, it's not working and I don't know that I will get to where I need to be. And maybe I do need to do something differently. And the value in selling is phenomenal. Yes, there will be tax. I get it. And that will hurt. I get it. But it's like the guy in the forest who's chopping down a tree with a blunt saw. He's working his butt off, sawing this tree. And someone comes up and says, that looks like hard work. He goes, it is so hard. And he's going hard and nothing's happening because his saw's so blunt. And they go, did you ever think of sharpening the sword? And he goes, can't you see how busy I am? If you leave the current train of thinking, go back, sharpen the mind, look at the different alternatives, you can see that there are different ways to do this that will, in fact, be a far better opportunity win for you than to stay with what you're doing, perhaps. Yeah. The opportunity cost of repeating what you know and ending up with what you've already got could be significant relative to what the opportunities that could exist if you chose a different path. Experiment, explore, at least entertain the idea of a different way of thinking. And therein lies the invitation.
I mean, if what you're doing today, what you have done to date with your property investing has not delivered the outcome that you want and doesn't feel like it's going to deliver the outcome that you want, then you need to do something differently. I mean, the definition of insanity, Brendan, isn't it? That you keep doing the same thing, expecting a different result. You're going to have to do something different. And we'll talk about that tonight. It is a different way of thinking. What we need to do is approach our investing from the perspective of, how do I solve the problem here? How do I make my property investing, my building of my portfolio, a repeatable, sustainable, and scalable approach? How do I systemize it so that I am building capital faster? How do I do it so that I can actually recycle and compound the capital growth that I'm getting? How can I do it so that I can recycle, reuse, and increase my borrowing capacity so that I can continue to scale up? And it's fascinating when you start to unpack this, that you start to identify, well, okay, there are certain problems that I've got to solve. One of those key problems is, where does the money, the cash, come from to actually put into these properties to build my portfolio? And one of the areas we'd suggest you might want to focus first is on building the capital base, building up the amount of investing capital that you've got, and starting to use that to work on compounding growth, work on recycling that capital and recycling the borrowing capacity before you start holding properties for the long term. So work on building the capital base up first. That's the objective if you're investing in the initial stages and the initial years, until you're at a point where you can start to park that capital into assets that you can hold. Now, I want to unpack that tonight and really look at what does that mean strategically. But it is a different way of thinking. People go, I've got to buy a property, and they sink their capital into it. They use borrowing for the balance. They go, I want to buy another property. Oh, where is my capital coming from? I can maybe borrow a little bit out, or I've saved up some, I sink that into my property. Go to buy my next property, I'm out of capital. What the hell am I going to do now? I'm stuck. I've just got to wait. Well, we don't like waiting, do we, Brendan? We're fairly impatient blokes at the best of times. So let's work on how you get past that, how you overcome that. I like to think of this as finding your path of least resistance. It's about trying to figure out what's getting in your way and what's your easiest way to overcome those obstacles. Focus on breaking down the barriers in order to make this stuff happen. And it's a different way of thinking again, isn't it, Brendan? It's about thinking of your property investing as solving a set of problems that are common to getting any property deal over the line, to getting your next property deal over the line. You need essentially 4 things. You need to be able to find the property deal that makes sense. And by makes sense, we mean it's got to be the right kind of property in the right kind of area that's obviously going to improve in value, not go down in value. And it's got to fit in with your financial goals. So if you've got a goal, for instance, of getting out of the rat race in the next 5 years, if you want to actually quit the corporate world, quit your job, then does buying a property that relies on it going up in value over the next 30 years actually fit that financial goal?
Yeah, no.
Chances are it probably doesn't. So we need to do something a bit differently. So the deal that's the right property in the right location with the right numbers, the right fit to your financial goals. You need the skill. So anyone, Brendan, anyone can go out and become a property investor just by signing a piece of paper called a contract, as long as they've got some money and some borrowing. Not hard.
Yep.
But there's no skill involved in that, is there?
Yep.
And ultimately, if you're playing with hundreds of thousands of dollars, you really ought to be investing in yourself first to build some skill. So you want to apply some skill to these decisions. They're massive decisions. They have consequences that can run for years. They need to be informed, educated, skilled decisions. So you need to build up your understanding of strategy and what is an appropriate strategy to be applying based on what you're trying to achieve financially. You need to get to grips with the numbers. You need to understand at least the basic numbers in a property deal, how they all come together. What's it going to cost me to do this deal? What are the ongoing costs? What's the financial profit outcome quantified that I'm looking to get out of this? And you need then the skills to be able to execute the deal. Beyond that, though, because that's all about what do I need to work on me, I need a couple of other things. Every property deal requires money in 2 forms. One is the capital to cover things like the deposit, the costs involved in the property deal. And the other is finance for the balance. Most people don't walk around with massive briefcases full of millions of dollars paying cash for properties. So most property investors will need to use leverage or finance to complete a property transaction. And that can be finance for the purchase of the deal. If you were doing something to improve the property actively, like a small development, then you need finance for the project as well. And if you're looking to extract equity from that property at the end, you need to be able to refinance. So whatever you're trying to do with your property, you've got to bring all 4 of these things together or nothing happens. So your job as an investor from tonight forwards is to become an expert in solving all four of these issues. And you navigate your way between them. You look at, okay, I've got a deal over the line, and I've automatically got a problem then in one or more of these areas. I'm either looking for my next deal, I'm trying to apply a new strategy, so I've got to skill up in it. I've got a lack of capital that I've got to overcome. So I've used up my deposits. Where's the next one coming from? Or maybe I've hit a finance limit, or a combination of these. And again, it's only when I get a tick in all four of these boxes that I get the next property deal over the line. And so your mindset as a property investor needs to shift to being someone who's working constantly to navigate around all four of these things. Now, ask yourself, when you look at these areas, these four things, what are you already strong in? Do you have plenty of capital? Do you have plenty of borrowing capacity? Do you feel like you've got a lot of education and skill and you're just looking for the next deal? Or do you have a weakness or an area, an obstacle in any of these areas? Am I going to run out of capital first? Am I going to run out of borrowing capacity before too long? What is the greatest
clear
obstacle?
on what I need to do or how I need to go to progress forward? Is there anything I need to learn that would help me do this better?
Exactly. Do I need to
know how to
up?
find the right property? All things are questions of self that from that you go, okay, well, what do I need to fill first? Where do I need to go first?
Exactly right. So if you know where you've got strengths in this space and what you're missing, you can start to identify what I call a path of least resistance. If I know what I'm going to run out of first, so I'm going to run out of capital first, that I've got plenty of borrowing capacity, then what strategies can I employ that are going to help me build the capital whilst using my existing borrowing capacity? If I'm going to run out of my borrowing capacity first, but I've got plenty of capital, how can I preserve or increase my borrowing capacity? What strategies can I employ to do that? And how am I going to apply that to my property deals to make stuff happen? What's my path of least resistance? If we bring this down to different things you could do that are different to the traditional approach to property investing. So rather than buy, hold, negatively gear and never sell, which creates a problem with, I've just soaked up a whole pile of capital that's going to be sitting there for a long, long time. I've got a reduction in my borrowing capacity because of the negative cash flows, and I'm just waiting for growth, or I'm waiting for a pay rise, or I'm waiting for rent increases to try and help me out there. What could I do differently? And there are so many different ways that you can approach your property, but certain strategies are geared towards solving certain problems. So if I am short on capital, maybe I head down an active investing path, or what we call a wave of growth investing path. So Brendan, active investing is forcing value into a property, creating your own value rather than just relying on market-driven value. Yeah,
right. It's often termed as manufacturing growth. It is energy and effort off the back of your own skill and ability, or that of which you employ, for the purpose of adding value to a property and then on selling it at a higher price for a profit. Buy, add value, sell, take a profit, repeat.
But there's that word again, sell.
I know it's a harsh word, but to that back end, if you do sell, you release your capital, you release your borrowing capacity, you've released the profit, which gives you more money, more time, and more leverage to get into the next size property deal. And in that, then you can start to really amplify your ability to make money more rapidly.
Yeah, or to multiply the number of property deals
correct
that you're doing. And once you've done this a few times, you might get to the point where you go, right, now I can take some of the profits that I've created and actually put those into properties that I am going to hold for a longer period of time and start building that longer term portfolio, rather than sinking all of that money into a longer term property straight up front and then I'm done. I have no more working capital to go and do something else with. So it's about being intelligent about your path of least resistance, where the obstacles are, and applying the right strategies to overcome those obstacles to keep going. Waves of growth investing, Brennan. Isn't property investing all about time in the market? You can't time the market, can you?
Actually, funnily enough, you can. Many people have gone for the model of its time in the market as opposed to timing the market. There are ways that you can read the market and read the market very well. And there are opportunities that you can access to get into the market at the right time. No two suburbs behave the same way at the same time. Suburbs are in growth while others are in decline. You get examples like a reduction in interest rates or a first homeowner buyer scheme come in, and you get a broader elevation of enthusiasm into the property market, and you see lifts. No two suburbs will grow the same amount at the same time. And if you get to understand the dynamics at a suburb level around what's happening, then you can read where it is that would give you the greatest opportunity for really good growth. And the wave of growth lasts for a series of years, not forever. You're not going to get 10% per annum for 20 years. It will grow, and then there'll be periods of flat. But even in periods of a flat for a city, you've got suburbs moving up and down all the time. So there's always somewhere to put your money. That said, you can then ride waves of growth and do so repeatedly. But yes, it does require more energy. It is an active hold strategy, not a passive hold strategy.
Yeah. And this is the whole reason why we've built up Property Predictions, our market analytics organization, is to be able to read these short-term trends in the market so that you can time your entry and exit points, so that you're much better armed in understanding whether it makes sense to invest in a particular suburb at that point in time, or you'd be better off somewhere else, whether it makes sense to hold a property and continue to hold a property based on its immediate growth outlook, or if there are warning signs that might mean, hey, this one's had its day, maybe it's time to release it and recycle it into something else. And to time not just the buy-in, but also potentially the selling out, in order to maximize the gain that you've had, realize that gain, and then recycle it into something else to keep building that capital. Really cool stuff. And we've run webinars, particularly on this topic as well. There's a question in the chat about, can we please share more about how you time the market? Now, that came in before your explanation, Brendan. So I hope we've addressed that, but perhaps with an example. If you jump into the real estate success community, so just go to realestatesuccess.community or search it on the App Store or Google Play and jump in for free into the community, you'll find some of these resources in there, some of the past sessions we've run on this, and no doubt we'll run more in the future as well. So we're not going to get into too much more detail on that tonight, but just know that that is available to you as another strategy. It doesn't require you to be a renovator or a developer. It's a smarter way of reading the market, reading that balance of supply and demand and the trends, to know, does it make sense to enter or exit a particular suburb at a point in time, so that you can really get some quick runs on the board in terms of rapid growth. And rapid growth, we're talking sort of potentially 10% plus growth in the value of a property over a 1 to 2 year period right up front. And not just doing it randomly and getting lucky, but doing it with a system behind you. So that's a great strategy. And obviously that can then be combined with the active investing strategies to get a double as well. What about positive cash flow, though? People will often say to me these days, Brendan, oh, you can't do positive cash flow properties anymore. That strategy disappeared like 30 years ago.
If you had started your investing 20 years ago, you could have done it. But today, no.
It was so much easier. Well, it was never easy to do positive cash flow properties. But having done numerous positive cash flow properties over the years, I can quite confidently say that this is a strategy that has not disappeared. There are positive cash flow opportunities out there.
Very real.
Both ones that you can buy with a little bit of effort and put together, and also ones that you can create, both in the residential and the commercial space as well. The great thing about positive cash flow, though, if you've got a property that is paying you more, even with, say, a 70, 80% loan on it, it's paying you more in the rent than it's costing you to hold once you take into account your interest payments, your property management fees, rates, and whatever. If it's giving you a net surplus, that has a couple of benefits. One is it's obviously easier to hold. It's not hurting to hold, unlike a negatively geared property, which is eating away at your lifestyle. The other aspect to it, though, is that because it's covering its own costs, it's preserving and potentially actually increasing your own borrowing capacity. So if you can accumulate multiple positive cash flow properties over time, your borrowing capacity doesn't go down. In fact, it potentially goes up. So you've solved that obstacle in terms of running out of borrowing capacity. The thing is, though, and none of the books on positive cash flow investing ever mention this, as I discovered early on in my own investing journey, Brendan, and we bought a positive cash flow property, got another one, thought this is great, kept going back to the bank and saying, can I borrow more? We suddenly ran out of deposit funds.
Yeah.
Because the reality is that you actually need money to buy a positive cash flow property, not just borrowing. And no bank, especially these days, is going to lend you 100% of the purchase price of a property without other security. So you've still got to find the capital to invest. And so even if you've got lots of capital straight up, going down a positive cash flow path might be a way that you can proceed and start to build your borrowing capacity if that's your path of least resistance. But if you've got limited capital, then before you get enough properties in your portfolio or enough cash flow to fund your lifestyle from these properties, you're going to run out of deposit funds. So you need to take a different approach. Where's your path of least resistance? What does that imply about the strategies you want to take on? So let's talk about that whole issue of running out of money, running out of borrowing, because that is the key thing I think that most people see as their primary obstacle. But not to diminish the idea that you need skill, you need to know how to do the numbers on property deals, you need to be able to understand how to read the market, and you need to be able to have techniques for finding good property deals as well. But let's talk about the funding side of it. Now, one of the biggest issues we find when people are running up against a funding obstacle is in their existing portfolio. It's been created by the way that they've invested to date. And the fact that they're out of borrowing capacity could be a direct result of the properties that they currently hold, or the fact that they've got limited capital. So the question you first want to ask yourself when faced with issues about where I'm going to find money, where am I going to find borrowing, if you've already got properties, is your current property portfolio actually holding you back? Is your current portfolio one of the key reasons why you're not moving forwards? And that comes down to looking in the cold, hard light of day as to how well those properties are actually performing. What are the numbers in that portfolio? Do they stack up? How do those properties fit with your financial objectives? Do they fit? And so one of the options here then, obviously off the back of tonight, if you'd like to work with one of our team to understand that better with your own property portfolio, look for whether there are issues with the portfolio that can be addressed or need to be addressed to move forwards, is to take advantage of that free portfolio review and strategy session that we're offering tonight. Now, there are only limited spots available for this, and I can see a number of people have already put their hand up to grab one of these spots. So if you haven't done that yet and you'd like to run through that session, then please do put in the chat your name and your mobile number. And then we will reach out over the next couple of days, figure out a suitable time to organize that session with you and make that happen. But it could really be revealing, and it might be the real thing that gets you onto the next step with your property investing journey, is to be able to identify where are those obstacles, or get the reassurance that what you've already got in your portfolio is actually helping you move forwards, and it does make sense to retain it. Either way, it's a valuable session to take on. So don't forget that's available tonight. But let's talk about addressing funding barriers. So if the current properties are not performing, why would you hold something that's not actually helping you achieve your financial goals? And that's where we've got to shift that mindset away from never sell to, does it make sense to sell? Is selling this actually going to help me move forwards on my financial goals, whereas holding it is hindering my achievement of my financial goals? What's going to get me to those goals faster? Does it make sense to sell? And the benefit then potentially of selling is releasing capital that can be put into things that are going to help you achieve your financial goals, and releasing and recycling that borrowing capacity for the same purpose. What about positive cash flow property deals? If I've got a limitation in borrowing capacity, but I've got a lot of available cash or equity, perhaps my next deal should actually be a higher yielding or positive cash flow property in order to preserve the borrowing capacity that I've got, or start to increase that borrowing capacity whilst still using the capital that I do have available to me. Or if I've got more limited capital, and in order to build my property portfolio, I've really got to expand that capital base, then a great way to do that faster might be some of those short-term value-adding deals, Brendan, that you talked about before, perhaps taking a property and renovating it to increase its value, or subdividing off a backyard, or doing a small development as a way of getting that capital base built up faster whilst recycling the borrowing capacity along the way until I've got enough that I can start to park into the properties I'm going to hold for the longer term. The other thing I wanted to talk about tonight, Brendan, this is a thorny one that comes up every now and then. It keeps popping back up. And I stumbled across this on YouTube just last week as well. So I thought it was probably worth mentioning tonight. There is a bit of an idea, a concept, I would argue a myth out there that you can get basically infinite borrowing capacity. Doesn't that sound awesome? Infinite borrowing capacity.
Very attractive.
By, rather than buying a property in your own name, by doing it under a trust structure. And the idea is that, or the theory behind this myth is that if I borrow under my own name, then the bank's looking at all the debt that I've got in my own name. And as I add more debt in my own name, because I'm buying one property after another until I hit a borrowing ceiling, that eventually the bank's going, you've got all that debt in your own name, you can't borrow anymore. You're out of borrowing capacity. You just simply can't afford it. So we're not going to lend anymore to you. But we're told that if I instead set up a trust structure and I go to the bank and I borrow under that trust structure to buy a property under that trust structure, and the bank might go, okay, well, we'll use you as a guarantor for that loan, so you can get that borrowing, that's fine. And then I go to buy another property and they look at me and say, okay, you can still go guarantor, we'll give you another one. When I get to the point where they go, you've got no more borrowing capacity, that's okay. I go set up a new trust structure and I'll go to another bank and I'll borrow under that new trust structure and replicate my personal guarantee across, because the theory is that that debt's not mine, it's the debt of the trust. It's not vested in my name, it belongs to the trust. Therefore, I can effectively clone myself, clone my borrowing capacity, reuse it all over again in another trust. And then when I run out of borrowing capacity in that trust, I'll do it again and do it again and do it again. Absolute nonsense. It's never worked. And I remember coming across this a couple of decades ago. It's never worked. It doesn't work. It's a myth. And the reason it doesn't work, and particularly will not work for your traditional property investments, your traditional negatively geared property investments, is that the bank will always want to know how it is that this loan is actually going to be serviced. And if they're relying on your personal guarantee, and especially in this day and age of the whole consolidated credit reporting, where the bank has essentially a 365-degree view of all of the debts, not just that you hold, but also what you're guaranteeing, they're going to look at that and go, I don't think that you can actually afford all of these multiple loans that you're trying to get, despite the fact that they're across different entities. Because they will look through the trusts, they'll look at you as the guarantor, they'll ask you, what else are you guaranteeing? And you have to declare that, otherwise that's fraud. And as soon as you've disclosed that, or as soon as they identify that just through the credit reporting, you're kind of stuck. So it just doesn't work. Besides which, if these things are all negatively geared, negative cash flow, where's the money coming from to service the shortfalls? So how are you going to fund across your multiple trust structures all these shortfalls without them actually going bust? So it just doesn't work. What it really relates to, where this idea really came from originally, was the notion that, particularly if you were borrowing under a trust, you might reach a certain limit in terms of the amount of debt that you had or the number of loans that you had, where the bank might have gone, we've got too much risk concentrated in one place, i.e. you. Therefore, we're not going to lend to you again. And it might be that you weren't actually out of borrowing capacity, but it was just seen to be too much concentrated with one entity, one individual. And so in that instance, it would potentially be possible to go and set up another entity and go to a different lender where you didn't have the exposure and continue to borrow as long as you could still demonstrate how the loans were going to be serviced. And that's kind of where this idea came from, but people have corrupted or perhaps not understood the idea. And so it led to this myth that you could just replicate your borrowing capacity magically by creating trust after trust. So it really just doesn't work. There's one scenario in my experience where this can potentially work, but it's not really magic. It's the idea that if I've got a trust structure or a structure where I've bought properties that are self-sustaining, in other words, positive cash flow. So they create enough income to service their own debt with very little reliance on me. I might still have to be a personal guarantor for those loans, but the reliance on my guarantee is minimal or insignificant because the properties themselves service the debt. And so in that instance, if I happen to hit the risk limit with a particular lender, sure, I could possibly go replicate that entity and continue doing the same thing, but it would have to be on positive cash flow properties in order to preserve and increase the borrowing capacity, make them self-sustaining entities in the eyes of the lenders. And chances are I'm going to be doing more stuff under business banking than typical resi lending. If you're trying to do this with borrowing in your own name, well, you've got the whole responsible lending area where there's a high level of scrutiny on your personal ability to service the debt. And so it can only be done in those very limited circumstances and typically with positive cash flow properties. Does that make sense?
It does. No, I did well.
So what are our alternatives? How else can we tap into things? Well, over the years, as we've gained more experience with our own investing and we've started to understand the lending environment better and better and the different options that are out there, our eyes have been opened up to a whole world of different lending options that are out there. Now, we can't advise people on lending. We're not financial advisors, so just make that clear right up front. But just from the perspective of opening people's eyes up to what some of the possibilities are out there that you might not even have heard of, you might not even know exist. Most people are familiar with the big five banks and their subsidiaries, right? The banks, if we want to call them that. And most people are familiar with the idea of going to the bank and applying for a loan in their own name. Whenever you do that, when you're borrowing in your own name, as I said before, it's all about the responsible lending regulations that exists, which means it's a real focus on you and your ability to meet the debt repayments at an interest rate higher than what you're actually borrowing. And so if you can't demonstrate that, you don't get the loan. If you can demonstrate that, you do get the loan. And you own the property in your own name in that instance. But it's very much on your personal servicing. You can bring the rental income of the property to bear, and most lenders will take into account something like 70 to 80% of the gross value of the rent as a contribution towards income for servicing purposes. So that can certainly help you. And obviously, the higher the rent of a property, the more it benefits you from a borrowing point of view. But how do you go beyond that? The more sophisticated investors, and as you become a more sophisticated investor, you'll start to identify these options. The more sophisticated investors tend to use non-banks. They tend to use even what are called private equity funds, which are essentially funds that have been put together to service a bunch of investors who put money in, and then those funds lend that money out. And they can apply a bit of their own discretion in terms of how they lend that money out and to whom they lend it out. The thing is, though, that these loans are typically more like a commercial loan. So they can be a little more expensive than residential finance, but they can be far more flexible. Also, they aren't typically lent to individuals. They are linked to things like companies or trust structures that have what's called a corporate trustee, which is a non-trading company that sits over the top and makes the decisions. So you might control that company, but it's the company as trustee for the trust that's doing the borrowing, not you personally. And because that is a business entity, it's a company, it's not an individual, then it's not really part of the responsible lending regulations insofar as they apply to consumers. And that gives those lenders greater flexibility in terms of how they lend. And that can be a way to solve a lending problem where if you can't get the borrowing that you might get under residential terms, you might be able to get under these terms. The question simply becomes, does it work for you on the numbers? It might be more expensive, but will the deal wear it? Great, if it will.
Just to point out here, we are not holders of an Australia Financial Services license. We are not accountants.
Yep.
We are not solicitors. We are people talking about the pragmatic ways of solving problems with property investing processes or where you might get stuck.
From an investor
this is not personal advice. This is not tax advice. This is not financial advice. These are broad, high-level educational conversations centered on your ability to think differently. And our encouragement absolutely is go to your own accountant and make sure that it works for you and your personal circumstances and your solicitors, etc. Just wanted to raise that because we are talking about accounting terms. Just wanted to make sure that you don't go, oh, Simon said
I should have a corporate trustee for a trust or something
just
like
raising that.
So this is all just from the pragmatic perspective of, as investors, these are things that we've done. And these are the kinds of things that are out there that you may or may not know about. One of the lesser known forms of lending is, you could call it asset lending. And the way this works is I might be wanting to buy a property in a metropolitan area and it's got an established house on it, but I personally can't demonstrate the servicing that's going to be required, maybe because I've got a number of other properties I've got debts on or whatever. However, it may be that I can find one of these non-bank lenders or private equity firms that might have a thing called an asset loan or an asset-based loan, where they might allow me to get a valuation on the property, and then they might lend purely against that valuation without really being that concerned about my personal financials, so that I can then buy that property. It might be at a lower LVR, so it might be I can borrow 60% of it. I've still got to tip in 40% plus stamps, but it enables me to get that deal over the line. Again, path of least resistance. Do I have capital and lack borrowing capacity? Maybe that's a potential solution if I could find one of these lenders to do that. The thing is that those lenders, being non-bank lenders and doing something that's a little bit outside of the realms of your typical consumer lending, are not going to lend that to you as an individual. Right? They might consider lending it to a company. So you might have to set up a company that's going to go and buy this property. The other thing to bear in mind is that those loans are typically short-term. So this could be a way of, as a stepping stone, securing a property where you know you're going to be able to get finance down the track to refinance it out as normal residential lending or on a cheaper rate for a longer term. Or it might be, hey, Brendan, I've got a renovator that I want to do, but I'm struggling to raise the borrowing to secure the property to do the renovation on, but I've got a decent amount of capital. I could throw it into the deal in a loan potentially like this, get the deal done and dusted inside of 12 months and be out before the end of the loan term. And these loans, as I said, are short term, which typically means somewhere between 12 and 24 months that they run for. And then you have to be able to either repay the debt through a sale or refinance to something else. But these sort of options are out there that if you don't even know the possibilities exist, you don't look for them. Part of it is knowing, and Brendan, you have a great way of expressing this, the whole idea of we know what we know, we don't know what we don't know. And there's that whole world out there, isn't there?
That's where possibility exists, correct. So there's stuff you know, there's stuff that you know you don't know. And in the world that you don't know about, that's where all the answers generally lie. And that's where possibility for a variety of different outcomes exist.
Yep.
And the encouragement is to consider that. And how do you get access to the areas you don't know that you don't know about? You make inquiries. You talk to people who have been there. You talk to the people around you that have done it before. You talk to the people who are where you want to be, and you explore those conversations with them. Case in point, talk to a property mentor and start that conversation. That will give you access to a wealth of knowledge that you may not know exists right now.
Yeah.
Simon's conversation in the last 15 minutes has all been about different ways of doing finance that is a sophisticated approach to making finance happen that the vast majority of property investors would know little or nothing about and may never have heard of. And that sophistication brings a solution to a problem that allows you to keep going.
Yep.
It's a classic example of delving in the space that you don't know about right now. It's brilliant.
Exactly. So do let us know if you'd like to sit down and have that sort of a chat and explore some of the possibilities that are out there that might help you move forwards. Development finance. So if you were looking at building something and you were wanting to, let's say, build a series of townhouses, but you don't think you can afford the loan because it's going to be several $1 million of lending. Well, you don't have to personally be able to afford the loan. What you have to be able to do is understand the finance options that are out there that don't actually rely on your personal servicing to get that construction loan. I mean, we recently went guarantors on $17 million worth of construction, Brennan, on a single project. And not because, I mean, we don't try to go out there and pay too much tax. So not because we've got enormous tax returns that we would demonstrate for personal servicing. It's because the type of lending that we deliberately used on that project does not require reliance on personal servicing. It requires, a bunch of other things, like things like you might have to sell some of these properties off the plan to demonstrate that on completion, they'll repay part of the debt. There's all sorts of different ways of putting this together. Just know that the possibilities are out there, but if you don't even explore those possibilities, then you're stuck. And you don't see the way forward. So as Brendan said, talk to people who've done this sort of stuff before and look at what the possibilities might be and potentially leverage their connections in this space, because you won't generally get a lot of these options through typical banks and brokers. Your average broker that deals with the mum and dad home buyers, the first home buyers, or the traditional property investors often doesn't have the knowledge or the connections to be able to access these forms of lendings. Not all brokers are cut from the same cloth. So you need a more sophisticated broker to support your property investing.
To solve a problem, absolutely, and move on.
But you don't even have to go to banks. So a big mindset shift. I think a lot of people, Brendan, see themselves as a bit of an island. Right? My investing is all about me and what I'm trying to achieve, and I've got to do it all myself. And that is one of the most limiting mindsets that you can have as a property investor, especially if you're trying to do big things, if you're trying to build a multi-property portfolio, if you're trying to create a really financially free lifestyle for yourself. You don't have to go it alone. Brennan, I've often thought, and this comes back to something somebody said to me way back in the formative years of my investing, that if a deal is good enough, if the numbers stack up, if it's got good figures in it, good profits in it, you'll find a way to do it.
Yeah.
You need to back yourself to be able to find the way to do it rather than let great opportunities slip by. Do you think there's a big shift in thinking for somebody to go beyond themselves and to start to consider tapping into private funding, joint venture partners, money partners, that kind of thing?
Oh, it's huge. It's huge. I mean, if you come across from the perspective of you are an island, this is all about my ability to service debt, my ability to come up with cash, my ability to buy it so that I own it. Now, they are all in individual perspectives around an individual way of being. And if you start to shift that into, hang on a minute, the project requires some work and energy. There is a sale period, a sale date. There is an end to it. It's got to start. It's got to finish. If I don't have the capital, then do I walk away or not? And goes back to if the deal is good enough, the money will come. If the project is good enough, the money will come. And you just tell people about it. They go, oh, nice. If I give you some cash, could you see the project through? And then you get to start the mental shift around, oh, it doesn't have to be me. If I use other people's money and pay them a reward for using it, I don't know, I could be like, or they could be like the bank. I give them an interest rate for the money that they give me privately. Or if I go, I've got so many projects on that I'm doing right now, or I've got a couple of projects on that my borrowing capacity is limited, but John's borrowing capacity is really good. Maybe we could do something together where we use his borrowing capacity and my leftover cash, and I get to go again. Do you see where I'm coming from? So you start to think about
the win. You share the profits.
Correct. And you're not an island. And suddenly you can start to play and interrelate with other people inside the ocean that is property investing.
Exactly.
It opens the door.
It does. And it can be a real accelerator. And I've found this through my own investing. Working with others can be a massive accelerator to what you're able to achieve. And you can achieve so much more. And yeah, you share part of the profit. But I've got to tell you, Brendan, half of something is a hell of a lot better than all of nothing.
Yeah.
Into the week. So if it helps you move forwards, then yeah, it's outside the comfort zone of a lot of people to even think this way, or even to start to consider this. But it can be a fantastic way of moving forwards. Now, don't think that you'll easily be able to use partnering with others as a private lender or as a joint venture partner as a way to build a portfolio of negatively geared properties, because one of the fundamental questions is, how does that person get their money back? When do they get their money back?
Oh, never.
So it works far better on short-term projects. So if you were trying to do something like a renovation deal or a small development, something like that, this kind of approach can be quite effective. It generally won't work for the long-term hold stuff. But how do you find people like this? How do you find people who are open and willing to work with others and partner with others in investing? Well, you network.
Yeah, there are groups of people right across your city, wherever you are, right across your city. There are groups of people who connect and talk about property investing. And if you go there and you just have conversations around the level of activity you're up to, listen to the level of activity that they're up to, talk about what might be possible where you're stuck, you might stumble into a relationship that goes, actually, we could play together.
There are right ways and wrong ways to put these things together. And it's critical that you have you and the partner have appropriate legal advice and get things documented right and set up the correct.
Not a random collection of people who throw money into a pot and say, let's go and buy something.
Yeah,
because that won't work. That will end up badly. Don't do that.
No.
But there are ways you can do this and do this safely.
Correct. Now, the other thing I would add is, if you're looking to build relationships with people to potentially create investing partnerships or whatever, well, I know there's a community out there of active, forward-thinking investors all about building wealth called the Real Estate Success Community. If you're not already part of that, and this is the kind of thing that you want to explore, then might I suggest that it could be a good idea to actually get onto the real estate community, real estate success community. So again, just go on the web to realestatesuccess.community and you can join up for free there, or search the app on Google Play or the App Store. Just search Real Estate Success. You'll find it pretty easily. Is the app able to be used on a laptop? Yes, it's web-based as well as mobile-based. So you can get the mobile app, or you could just go to realestatesuccess.community on the web and you access it on your laptop that way. Cool.
Wonderful.
So rounding out tonight then, Brendan, what are the rewards of thinking differently? What does it actually get you, and how can we see this play out in terms of this idea of scalable, repeatable, and sustainable investing to build your wealth, build your portfolio? Well, we can just draw from just a couple of really recent examples in our mentoring program just to illustrate this. If you're thinking, I need hundreds and hundreds of thousands of dollars, millions of dollars to buy property, you don't. All right, Brendan, what's the cheapest median price in the country right now, more or less?
$40,000. You can actually buy in a suburb where the median price is $40,000. That's pretty cool.
Now, not that we'd necessarily recommend that, because there's a whole lot of other analysis that goes with that. But the point there is that there are more expensive and less expensive places around the country. There's a huge spectrum of property prices. So if you've got limited capital, limited borrowing capacity, scale down. You don't have to buy the most expensive property. Case in point here, this 1-bedroom unit in a strata complex in Adelaide was bought just recently for $170,000. A couple of our members, Beck and Adam here, did a renovation on it, completed that reno in just a short few weeks, made a 6-figure profit, $122,000 from that deal in a matter of months. Now, there's that whole idea of I'm building capital, recycling capital into other deals, and they've got multiple deals on the go at the moment at all levels, more expensive, less expensive. So more deals underway. This one here, just completed, is coming at this more from almost a positive cash flow point of view, but just proving the point that you can get positive cash flow and capital gains in the same property. This is a rooming house conversion done by Daniel, another one of our members, just recently completed. He made a net value gain on the property of $350,000 and created a positive cash flow of 25 grand per annum. Now, how big a chunk would that replace of your own income from a single deal?
Brilliant.
And therefore, how many deals like this would you have to do if you did want to replace your income?
Yep.
And he's got multiple deals underway as well. The point here is by doing deals in these sorts of ways, they become repeatable, sustainable. He's hanging on to this particular property, and he has the ability also, though, to leverage against it to get capital out because, you know what, it's positive cash flow, so it helps. Good stuff. Or taking it up another level again. If you've built your capital over a period of deals, you get skilled in doing deals like Steve and Mandy here did a series of subdivisions that ultimately led to taking on a larger subdivision, this one here, to create capital. So focusing on build capital first, then we're going to start to park it into assets that will hold for the longer term and build our portfolio that way. They built up their capital and their experience doing smaller to larger subdivisions, did this one. This subdivision made them a profit of $1.2 million in a single property deal. So what does that enable you to do? You then start to take some of your capital and put it into deals that you want to hold. In this case, they've gone down the commercial property path, reinvested some of the profits into 3 warehouses that they bought for just shy of $1 million. And the great thing about those warehouses is that they generate over $82,000 in passive income net. That's over an 8% net return on their investment. Plus, because they're doing this smart, they've got the skill, they've got the know-how, they've generated a 6-figure capital gain off this particular asset as well. And just this month, they've bought another similar property to add to their portfolio. Just brilliant. So when you're thinking differently, when you're not following just the traditional buy, hold, never sell approach, you can do so much more and so much faster. And that's the point here. If you want to build a multi-property portfolio, it simply requires thinking differently. Skill up, get the know-how, try on different strategies, talk to a mentor about what you might be able to do differently, and take advantage of the opportunity tonight to have a look at your portfolio, get some of those property predictions forecasts on the suburbs that you currently hold property in, see what the direction is. Are they looking good? Might they need to be course corrected? Unpack the numbers in that portfolio, look for the opportunities as well as the obstacles and what you can do to overcome those obstacles or capitalize on those opportunities. But take advantage of that opportunity, and we'll set that up in the next couple of days so that we can have that chat and get you moving forward faster on building your own multi-property portfolio.
Guys, I want to thank you ever so much for joining us today. We wish you the very, very best with your investing. And until we meet again, invest wisely.